Hey everyone, have you ever wondered how people profit off of trendy, meme-ish type names that are surrounded by a bunch of retail attention? Well, that is what we're going to go through today. Today we're going to go through how we can find these names, how we can validate if these names are truly being driven up due to hype, mostly centered around retail investors, and lastly, how we can structure trades to capture and make money off of these types of situations, just like the pros do. So let's go through how this analysis is structured fully, right? First, we have to look and find a place where we can, see where most likely these retail names are. And currently, this is a really good site. It's called Swaggy Stocks. It's the most mentioned names by Wall Street Bets in the past day. And what we can see is that we have Tesla, we have Apple, we have AMD, McDonald's, Amazon, Nvidia, etc. But there's one that really sticks out, and that is Carvana. And the reason that Carvana sticks out is because Carvana is not a super big name in terms of market cap, right? For example, retail involvement might be more in Tesla, but there's a lot of big smart money surrounding Tesla as well. So there may not be a whole lot driving there versus Carvana, which is much smaller in size. There's a much higher likelihood that it is there. Second, we kind of need to validate this, right? This is the second step of basically going through and seeing from a fundamental perspective and the quantitative perspective, is this the case? And this is a really good news article here that was posted yesterday. Carvana's 2023 rally tops 100% as options fuel meme style frenzy. This is exactly what we're looking for. Now, the fundamentals check out, right? This is what the street thinks it is. It's meme-ish, hype-ish, just a lot of people bidding up calls, etc. Now we need to validate this, right? And we're going to use the predicting alpha terminal to validate it. So first thing we have here is the skew structure, right? And these are the skews, which is, by the way, just how much more expensive calls are to puts or puts are to calls at any given time frame. So this blue line are for options expiring in about this time next week, right? The yellow line is options expiring in a month, and the green line is what 2 weeks out options were trading at a month ago on December 30th of 2022. Look at what the skew is to the call side today versus what it was a month ago on the exact same options. The 2 weeks out options. It is currently 260% IV, right? That is currently what those options are in terms of implied volatility for the current options 2 weeks out. And it was only 162% IV this time last month. So now we need to ask ourselves, we know that this name is being bid up on Wall Street Bets. We know that the street thinks that's mostly just due to option frenzy and people just bidding up calls. We have quantitative data that solidifies it. Furthermore, we can validate this further by using the predicting alpha terminal in the volatility insights tab. And what we're going to see is a lot of call skew as well. Just for reference, call skew in series tabs such as this are always going to be negative, and they're always going to be positive to the put side. So we saw this massive flip, and it has stayed down in this range in terms of having extremely high call skew during this time. We also can see that options have quote-unquote gotten more expensive over this past month relative to what they were before. This further validates the information. Now, with all of this being said, we now have our analysis. It's most likely be driven up by retail traders and people that are not price sensitive, do not care what they buy. And secondly, they most likely don't exactly know what they're buying at all, being that options are volatility products. So now, there might be an inefficiency here. These options might be overpriced because of this. And the way that we can validate that is by first, like I said, with the skews, but second, with this. Implied volatility versus forecast volatility is at a ratio of 1.39. This puts the options expiring in the next month, according to our quantitative forecast, of around 160% IV. But as we know, they're currently at 222, and if we go back to the skew tab, what we're going to see is that some of these options that are in the skew are at 260%. When in realisticness, they should probably be around 100 vols less. So now comes the fun part, capturing the inefficiency. We made the point earlier that these probably look a little overpriced in terms of just volatility terms. And the way that you would take advantage of something like that is selling a straddle. And what exactly is a straddle? Well, a straddle is selling a call and a put at the same strike, right? This effectively mitigates your direction risk entirely. Because as you're going to see here when we put this on the Thinkorswim Analyzer tab, you're going to notice that we can see here that there is no difference. Whether the stock goes up or the stock goes down, we are completely indifferent. What matters is that it stays between our break-even points, which are here and here. And that is the key. Now, is this the most effective way to capture this particular inefficiency? If retail traders are bidding up the calls one way, so they're bidding up options on one side, aka calls? Well, a straddle could be in terms of, the overall implied volatility being priced, but as for those call skew, not so much. You see, call skew, like I said, is the out of the money options. How much more expensive are the out of the money option calls versus the out of the money puts? Well, here's an example, guys. Look at the Delta 10 puts here. They're currently trading for 31 cents. Now, if we look at the Delta 10 calls, they're currently trading for around 29 cents. Almost double. More than double, actually. Or actually, no, it's around the same. But nevertheless, if we take it a step further and look at the volatility terms, you'll see what I mean. These Delta 10 puts are currently trading for vols around 208%. The Delta 10 calls, conversely, are trading for around 277%. This is skew in real time. So what can we do to capture skew? Well, we can trade something called a 1-3-2 fly. And essentially what we're going to do is we're actually going to buy options here. We are going to buy calls. Just one. Then we are going to sell 3 calls. Approximately around the range of $13 here. Into the skew. We're going to sell 3 of these, remember. Lastly, we're going to buy calls again. But we're going to buy calls at a strike point that chokes off losses. Maybe 14. We'll take a look and analyze this in real time. When we throw this up, you're going to see something. It's a very asymmetric risk reward. See? Very asymmetric. It's because we have 2 on. Now, nevertheless, you're going to notice that you're only risking on this trade $21 right now, $21. And if we just get a little move to the upside and then it just stays there, you could effectively 10x your money. If you're risking $23 and you make $230, 10x. Conversely, if this blows out, we take a $123 loss and we only lose the debit paid to the downside. Now, what these trades are doing is we are effectively expressing to the view that everyone that is trading Carvana, or most people that are trading Carvana, are not sensitive to the prices. They're bidding up the option prices to the call side. It's most likely not going to move, say, almost 50% between now and February 17th to the upside. Let's sell these options because they're most likely expensive relative to what the consensus is saying. So that is one way you can do it. However, as I said, volatility on this appears to be overpriced as well. Then straddle might be your best bet. The beauty of options is that it is a canvas, and you can paint whatever picture you think it should be. So that is what I have in this one, guys. I hope you really enjoyed it. If you have any names that you would like us to analyze for you, feel free to comment below or message me, and I will see you guys in the next one. Thanks. Peace.